Greetings, class. This video is going to cover material out of Chapter 2 and will include some things that you'll be required to know for the test that's coming up, but also some things that will help you deal with some of the problems and homework that are here in this chapter that you've already done in this chapter, but also problems that will be on the test. But this will also impact future problems and your understanding of those. So what I would like to do is to create this video that you can go back to and look at if you have questions about debits, credits, transactions, how those are classified, and so on. Now, they open this chapter with a discussion of financial statement analysis and ratios, and this is excellent discussion, by the way, and they do present some ratios that you'll need to know, although we haven't created a financial statement yet at this point in the chapter. But they do identify the way these ratios measure four different things: liquidity, solvency, profitability, and market prospects. These are things that we're going to be very interested in as accountants when we look at financial statements. We want the current ratio because we want to see if a firm is able to pay with current assets alone all of the current liabilities. And the higher that ratio is, the better. And then you're going to look at solvency. Well, how big is the debt ratio compared to the assets that they have? So here we have a 60% debt ratio for Apple, and then they note that Google's is better at 0.17. Profitability, we're looking at net income divided by net sales to figure out what is our profit margin. And here it's 21%, which is really sounds good, but they note that Google's is 22%, slightly higher. And then finally, they're looking at market prospects. And what this does is it compares the price per share that's being paid for our stock in the market to the earnings per share that we're reporting in the income statement. So the price per share is what outsiders are paying for our shares of stock, and we're comparing that to the actual earnings per share that we have. And so the price to earnings ratio here is 13.5, which is good. Google's is better at 27.25. So those are some of the ratios, and we'll get back into those later. But I want to talk about the basis for these financial statements. And we're going to begin when we receive source documents that indicate a transaction's happened. We're going to look at that and figure out exactly what has happened in this particular case, and which accounts is that going to impact. Now, this is a great way to picture the accounts. The accounts fall into one of three buckets: the assets, the liabilities, or equity accounts. Asset accounts, you know, we have cash, prepaid accounts, supplies, equipment, and so on. Liability accounts, we have anything we are owing in the immediate term. And in equity, it's a much more complicated mix of accounts, but it basically comes down to what we earn as a net income, and what we pay out as dividends, and what we have as stock. So we'll look at those a little bit later, but this part of the book gives you good definitions on each of these accounts. And I won't belabor this here, but this picture, this diagram that they give you here is an excellent way to think of equity. Equity is a combination of two things. One is the net income that you earn out of the business. So the revenues minus expenses, that's net income. And then that net income will be added to the value of the equity account. But dividends are going to be paid out of that net income. So typically when you have dividends, you're paying them out of retained earnings or net income. And that will show here this way. So you're adding revenues, subtracting expenses, and then deducting dividends, and all of that combined with common stock will give you the value of equity, the owner's equity here. So here you see an expanded version of that earlier diagram of the accounting equation with all of the accounts, and then they describe those here. So when we talk about keeping track of accounts, we need to set up a basic chart of accounts to identify which accounts we're using and which ones we have. We do that systematically by using these numbers to indicate which kind of accounts they are. So we have asset accounts, liability, equity, revenue, and expense accounts. And by the way, this is a much more simplified version, but a lot of companies that I've seen use exactly the same kind of numbering system. They may expand the number of the account numbers to 4 or 5 digits, depending on how many accounts that they have and how big the organization is. So this is a good organization of the chart of accounts here, and it shows you exactly how they fit within the accounting equation. So we enter into the double entry accounting question where we deal with debits and credits. And the big issue here is simply to remember that the debits are on the left, the credits are on the right. That's all that this means. It doesn't mean that you're increasing with a credit, although you might be. It doesn't mean that you're increasing with a debit, although you might be doing that too. It depends on which account it is. So the debit side is the left side, the credit side is the right side. And if a debit is an increase or decrease, it depends on which kind of an account we're looking at. So here are the accounts and how debiting and crediting impacts those. For the assets, a debit will always increase it, and a credit will always decrease it. For liabilities, a debit will always decrease it, and a credit will always increase it. Equity, a debit will decrease, and a credit will increase. Now, this is for the common stock account. This does not include dividends or some of the others, but we'll get into that in just a moment. If we expand the equity portion of the accounting equation, we'll see the expanded version of that here, and you'll see how these accounts, common stock and dividends, revenue and expenses, are opposite of each other. Common stock increases with a credit, decreases with a debit. Dividends increase with a debit, decrease with a credit. Revenues are just like common stock, and expenses are just like dividends. So basically, this model and having a good handle on this diagram will help you as you go through these transactions and you decide what exactly is happening here and how does this impact the accounts that I'm looking at. Do I need to debit them or do I need to credit them? And it depends. If you're increasing assets, you're debiting. If you're increasing liabilities, you're crediting. If you're increasing revenue, you're crediting. And if you're increasing expenses, you're debiting. So those are some examples. They do give you some information here that might help. It's kind of a way, an acronym, a way to remember. But DREAD is for those who increase with a debit, and that basically means debit's the normal balance side for expenses, assets, and dividend accounts. And credit, everything else. Credit is the normal balance for everything else. So they show you how we're doing T accounts, and we've done these in class, but basically you're putting in the transactions and then showing the calculation of the balance, the difference between the debits and credits. For cash, we expect this to always be a debit. If it's not, we've got a problem. So when we journalize transactions, there is a specific format for the general journal. When we enter these transactions, we're going to basically follow these steps they identify here. You identify the transactions in the source documents. You analyze the transactions, and you use the accounting equation to figure out where these transactions should go. And then you record the journal entry, and from there you post each of these items into the ledger account. Journalizing entries basically means that you're putting these in a book of original entry. That's what the general journal is known as. And that you're going to enter a debit and a credit, at least a debit and a credit for everything. So they've coded this example in Exhibit 210 to these letters to identify what these components are. There will always be a date. There will always be a title of a debit account, and the debit will always go first, and then you'll indent slightly to the right, and that will be the credit account, and the debit will appear in the left column, the credit will appear in the right column. So they give you the steps here to do the journalization, and that in itself is fairly straightforward. The biggest issue here is learning when you debit certain accounts and when you credit certain accounts. Now, when we talk about the general journal, we usually include a brief explanation under the transaction, and then we skip a line before we go to the next journal entry. If we're looking at the ledger account, the ledger is basically a listing of all the transactions in one specific account, like cash. We're not going to include an explanation, but we will include the debit, credit, and the balance. So as we post these entries, we're going to take, for example, this first journal entry. We're going to look at, okay, what's debited? Cash. We take that $30,000 and move it into cash as a debit and reference page 1 of the general journal here. Show that balance as a $30,000 debit. And then we come to the common stock and we say, okay, what are we going to do? Well, we're going to credit that in this account, 307. We come down here, we put the date in, the posting reference back to the journal, and the $30,000 credit that shows a credit balance of $30,000. The posting reference in the ledger is the account numbers that we're posting these items to. Now, again, we have a 4-step process when we're looking at transactions. We identify the transaction in the source documents. We analyze the transaction in the accounting equation. We record the transaction in the journal entry using double entry accounting, and then we post it to the T accounts if we're using T accounts as an example, but we are always going to post it to the ledger. So we keep track of that by account. So we identify, we analyze, and you see here the analysis shows an increase to cash and an increase to equity, and then we record. They go through these journal entries to show you how they're actually doing that, and then they post them into the T accounts or ledger accounts to show you exactly what they're going to do on each of these transactions. So if you have questions, many of these transactions that they show you here are transactions that you will see again and again. So if you see, for example, purchase supplies for cash, you'll see that transaction many times. Purchase equipment for cash, you'll see that a lot as well. Purchase supplies on credit or services, or provide services for cash. All of these transactions, maybe not every single one, but a lot of these transactions are going to be pretty routine, and you will start seeing them repeat throughout an accounting period. So they go through all of these transactions to show you what happens. For example, one of them that I would like to pay attention to here a little bit is if you are providing services, and you're providing services and charging the customers for that. In other words, you're billing them on account. They don't show the actual billing here or what you're doing to provide the services on account. But, oh, here it is, providing the services on credit. So basically what they're saying is you're providing the service, billing the person that you're providing the service to. The billing to that customer goes into accounts receivable as a debit because they're going to pay you that money, or at least they promise to. And the credit goes into consulting revenue. Now, the consulting revenue here is related to your main line of business, consulting. But you may also be including another charge in this accounts receivable as well, and it looks like they're charging them a rental fee. So they have rental revenue and they have consulting revenue. that are offset by the increase to accounts receivable. When you actually receive the money on account, you're not going to go back and do revenue again. You're going to debit the cash as it comes in to show the increase in cash, but you're going to credit the accounts receivable to give the customer credit for the payment they just made. So these transactions, I would highly encourage you to look these over and maybe develop a sense of what happens in each of these situations, because you will see these time and time again throughout many of the problems that we deal with. So you summarize all of these transactions in a ledger. They're showing these this is a T account, but really this is a T account is a very simplified version of a general ledger, and you can use those to model what's happening in the accounts very easily. And you see here the accounting equation remains in balance. That's probably the most important item we want to think about. And after we get all of those balances figured out through T accounts, we're going to create a trial balance. A trial balance is simply a listing of all of the accounts with their appropriate debit or credit balances, depending on what they have. So we're going to list out all of the accounts of the business and show the balances that they have. We have cash. Accounts receivable doesn't have a balance right now. We have these other assets that do. We have credits with accounts payable, unearned consulting revenue, common stock, rental revenue, salaries, consulting revenue, rental revenue, and so on. These are the credits. The debits over here are going to be things like dividends and expenses. You notice in the credit column, you're going to have the payables, which are liabilities. You're going to have common stock, which is equity. You're going to have rental revenue and basically consulting revenue, which is revenues. Those are the three kinds of accounts you should see credit balances with. And then over here is everything else. Basically, you want to make sure that these two debits and credits remain in balance, just like you're concerned with that the accounting equation remains in balance. So preparing the trial balance is really going through all of the detail that you have done up to that point, looking at the ledger, bringing the totals into the trial balance, and then you may need to look for errors. So basically, one of the biggest errors that I've seen in preparing a trial balance is that you get in the habit of going down the debit column, and then you get to accounts payable and you accidentally put it in the debit instead of the credit column. That's a very easy mistake to make. But you want to go through that and see if you're in the right column, if it's a debit or a credit. Another item that's easy to make a mistake with is transposing numbers. That if you turn two numbers around, like with consulting revenue, it's $5,800. If you put in $8,500, these are not going to balance, but that transposition error will show up in the total. When you're looking for an error, you can take this total minus this total, or the other way around, to see what the difference is. If that difference can be divided by 9, it's very possible you've transposed a number somewhere. If that number is divisible by 2, it's also very likely that you've put it in the wrong column. So depending on how that number comes out may indicate which kind of error exists in the trial balance. Then we go on to prepare the financial statements from the trial balance. And we're going to do the basic accounting statements. We're going to start with an income statement, a statement of retained earnings, and then we're going to have a statement of cash flows, and then finally we're going to have a balance sheet as well. These three accounts represent, or these three statements represent a period of time from one period to the next. This balance sheet is important to recognize is a point in time. It does not cover the entire month. Basically, with the financial statements, there are some presentation issues they give you here. Now, when you're talking about transferring numbers to the financial statements, and you've been thinking in debit and credit terms the whole time, you do not use debit and credit on the financial statements. You do the financial statements in a way that the presentation makes sense and people can understand what you're doing. So they give you some examples here of making decisions with ratios, analysis, and so on. He said this is really chapter 2 in its entirety. Right now I'm getting into some of the problems and some of the solutions, examples that they have. If you have a question and you'd like to learn more about what's going on in the chapter, these demonstration problems in the back, in this blue area right here, might be a good way for you to look at that and gain some understanding. You can see the solution here, the journal entries, the posting into the ledgers, and then finally the trial balance here. What is useful about this diagram is the way that it traces from the trial balance into the financial statements. So you can see where the numbers come from in the trial balance and go to in the income statement, that the income statement is then used for the retained earnings statement, and you pull out the net income for retained earnings, and then you subtract out cash dividends to show how much of the net income you're keeping in the business. And then finally, you're going to calculate the balance sheet based on these earlier numbers. This is the simplest form of a balance sheet, and it's basically what we've used most of the time. This is not the classified version, but this will work. You're going to list assets on one side, show the total, liabilities on the other. You're going to show a total liabilities, and in equity, you'll break that down into the different components, which is going to include common stock and retained earnings. And then you add those together to get total equity, and then add that to the liabilities to show that these two are in balance. Okay, that's pretty much chapter 2, and I've tried to go through some of the material and give you an explanation. Again, if you have questions about this, feel free to ask, but I'm going to post this video, and I will post another video from chapter 3 very shortly. Have a great day.